And what kind of trading week could we expect ahead? Well, let's talk to Kumar Palghat, Managing Director and Founder of Kapstream Capital, which oversees about $4 billion in assets. And he joins us from Sydney this morning. Kumar, good Monday to you. Let's talk about, I guess first off, let's touch on the U.S., shall we? Yeah, because we got to 2.2% GDP, which is slower than what economists had expected. But some say it's strong enough in terms of an economic read, but also weak enough for the Fed to instill maybe another round of quantitative easing. What do you think?
Morning, Susan. I think the economists are right in the sense that, GDP wasn't what they expected. They thought it was going to be about 2.5, came in at 2.2. Look, it's a weaker number than expected, but it's still a positive number. And in general, if you looked at earnings in the U.S. in the first quarter, things were pretty good, so corporate sector is doing well. We know the housing market slowly starting to improve. And anytime you see weaker numbers, you get talk from the Fed saying that they're willing to do whatever it takes and they're going to print more money into the system. So, again, in my view, as I've said before, I think the U.S. is on the way to recovery. Even if you look at job numbers, right, in the first quarter, they've created about 635,000 jobs. So it's not bad. I think you'll get some weak numbers here and there, but in general, the U.S. is okay.
Okay, well, is that the best place to be this year, given the, if you drill it down to the details of this GDP figure, the consumer looks healthy and housing looks to have stabilized as well?
It does. The most important thing is the consumer. So as rates come down, and what you're noting also is anecdotally that the refinance rate on 30-year mortgages or 5-year ARMs have come down to historical lows. So what's happening is banks are allowing you to refinance your home, so confidence is slowly starting to pick up. And as long as employment numbers are okay, I think the consumer starts to spend a little bit more money, which is sort of what you saw in the first quarter GDP numbers. And I think you need that to be sustained over a period of time, and then I think the U.S. seems okay.
All right. Well, we got, of course, gains on Wall Street on Friday to cap off the best week since March for U.S. markets. What kind of week does this mean for the Asia Pacific, given that we're expecting an interest rate cut from the RBA tomorrow as well?
Well, the European problem has hit Asia, so you're starting to notice people talk about a slowdown in Asia. China GDP wasn't what it was supposed to be. Australian GDP is starting to slow down. In Australia, the consumer is really struggling compared to the commodity side of things. So RBA was the first central bank to raise rates after GFC. Remember, they took rates from 3% to 4.75%. Now they come down to 4.25%. I really think tomorrow they probably should cut 50 basis points. And the reason they need to do 50 is if they do 25, the banks are not going to pass that through, and it's not going to be a lot of money for consumers in their pockets. But if they do 50 and the banks pass on like 35 or 40, that'll be a meaningful number to kickstart the economy again. So
yeah, that would be
my guess is they're going to do 50.
You think so? 50? So
it would be good.
Yeah. No, but okay, so I'm saying if they cut 50, right, what does that mean for fixed income, especially in Australia, which some have said have been a favored play given the yields we've seen in recent years?
Well, fixed income markets are already pricing in rate cuts of more than 50 basis points for the next 12 months, right? I mean, 3-year government bonds are yielding 3% when cash rates at 4.25%. So going long interest rate risk here seems a little bit tough because you need them to do more than 50 basis points. So, we're not long duration at all here. We like corporate sector, we like the banking sector, we like Asia. We continue to avoid the government sector here and overseas, including the U.S.
Okay, well, let me talk to you about Europe because, as you mentioned before, it looks like financial markets, the financial market patient has been stopped from dying. And you said right now the focus should be about not reverting back into a coma. What about Europe this year? I mean, it seems that we still have Spanish yields, by the way, still close to 6%, but still better than expected given that downgrade we got from S&P on Friday.
Yeah, look, I think Europe is going to be the biggest unknown for the next 12 to 18 months. You've got elections coming up in France, highly likely that Mr. Sarkozy will lose his office. Then you've got austerity measures where people are trying to, get their budgets in order. Spanish unemployment rates look really high. So when you have austerity measures in place, weak economic growth, it's going to be a tough haul for Europe and for them to meet their target. They still need a lot of funding to do, granted that the IMF and the ECB have provided a lot of money, but they still have a lot of funding to do. So markets are going to be watching Europe more critically over the next 12 months to see if they're going to pass some of these legislations through. And, 4 of the 5 governments that were in Europe over the last 12 months are no longer there, right? You got new governments in place. but the problem is still the same. So I think they're going to keep pumping money into the system to keep the economy going in Europe.
Okay, Kumar, it's always a pleasure to have you with us. Thank you so much for your time. Kumar Palghat, Managing Director and Founder of Kapstream Capital, joining us from Sydney this morning.